Welcome everyone to the real estate experience. Super excited as always to deliver you the absolute bombs and golden nuggets. Those of you on the YouTube, you know the next steps. Hit that subscribe button. And on today's episode, and all episodes moving forward as well, as we ultimately deliver value to show you the behind the scenes of how to put deals together, also the mistakes as well as the successes that encounter in the industry. So today we've got Michael Becker on the episode. Welcome, Michael.
Hey, thanks for having me on. I appreciate it.
Yeah, so just a bit about Michael is one, he, in terms of the Old Capital podcast, that is by far one of my go-tos to learn all aspects syndication and just more sophistication when it comes to putting deals together and just understanding that whole element. He is the principal at SPI Advisory, oversees all aspect property relations or property operations related, and has done transactions well over 10,000 units and owns close to about 6,000 units. And one fun fact too, you guys, is he previously was a swing dancer and may go back into it at some point, possibly.
The apartment doesn't work out, maybe.
Okay, perfect. So could you give everyone your 5% that's ultimately shaped you to where you are today and how you were able to get into real estate, Michael?
Yeah, like I said, my background's banking. That's kind of really where I kind of got my entree into the business. So it was loaning money to other people, have a background loaning on all the major food groups of commercial real estate, so office, industrial, retail, and spent the last several years of my banking career doing multifamily. Just kind of through that process, just realized I was on the wrong side of all those deals. Kind of better be the borrower than the lender. So really, that was kind of my motivation, just going out, seeing other people do it, and it's been a heck of a good run the last 7-8 years, doing 10,000 units. And it's, really been a phenomenal business to be in.
Gotcha. And one thing that Paul says is with that many units, you are considered the mayor of your own small town. Every time I hear that, I find it just hilarious. And
you would think about it. We have probably over 10,000 residents on our property. So it's kind of like your own little small town in the grand scheme of things.
And so why real estate when you're doing all those loans? What was it exactly that said, okay, now I want to make that transition to be on the other side and be an operator?
There's a couple things. I mean, really, I was about 35 when I finally kind of made the transition away from the bank. I started a few years earlier buying some single family homes, kind of like a lot of people probably started with a 3-bed, 2-bath house in Mesquite, Texas for, it was like $75,000 or $80,000, something like that. Spent $10,000 or $15,000 renovating it, leased it out for $1,100 a month. That's kind of how I got my start, and just ended up doing 16 rent houses and realized it wasn't very scalable. And then, so kind of reflect to what I was doing all day, every day. So really there's two things that kind of come to mind. One was, I was making, I made a lot of loans, but I made a loan to one particular gentleman or two guys. And one of them was like literally a bus driver. And, this guy had no money to his name, and him and his partner ended up buying a deal. And I was like actually making them $1 million+ loan. And I was just thinking to myself, like, if that guy can do it, like, no background, no money, no credit. I had, some resources that I've saved up over the years and a lot of experience. So it was that was a motivating thing. And there's nothing necessarily wrong with that guy, but there was that story and many other stories kind of similar that I saw every day, that the only difference between them and me was like, they're taking action. I wasn't. And then the other thing that really started getting me motivated in the first place before I started buying the houses was I was filing my tax returns one April, and I couldn't even itemize. I didn't have any tax deductions. I started getting mad at my CPA, and he's kind of just told me, like, listen, there's nothing I can do for you unless you start a business or buy some real estate. And that was really kind of like one of the big catalysts for me. It was like I was just sick of paying, the top top tax rate that I had, because all I had was wage income. So it really kind of motivated me to get out and be a little bit more efficient.
Gotcha. And so through this whole process, was there any limiting beliefs, or you just started taking action, just buying deals, or was there any, did you have any limiting beliefs when you made that transition?
Oh, sure. Yeah. I mean, everyone's got their own fears and anxieties when you go into this, like, what if I make a mistake or everything crashes and no one pays your rent? So I started small. I mean, I don't necessarily I think with the benefit of hindsight, I didn't necessarily need to start with like a single family house. But I bought, like I said, 16 of them I did. I bought them, generally they were foreclosures, renovated them, and, leased them out. So it was a good way to kind of project manage, and get some confidence in our ability to, take a deal, go full cycle, buy it, renovate it, lease it, refinance it, repeat. And kind of did that many, many times and ultimately sold those. So it was a good, like little confidence. And then kind of going into transitioning to multifamily, I ended up doing my first 4 properties, about 800 units. It was in 2013.
So you shifted from single families and then did a portfolio of 4 properties comprised of about 800 units.
It was actually my first 4 deals were one at a time, totaling about 800 units. I did that over about a 6-month period while I was still employed by the bank. So I wanted to go out and get some like credibility, because there's one thing to be, I was pretty well known in town. I made a lot of loans to all the brokers and management companies and everyone knew who I was. But everyone thought of me as a banker because that's what I was. I wanted them to kind of shift the mindset from a banker to a principal in these deals. And so fortunately, I found it's pretty easy. All you got to go out and do is do a deal, and then everyone kind of thinks of you as that. Until then, they second guess your ability to actually go out and do a transaction because you haven't done it. And it's because one thing being, like I said, a vendor, it's another thing actually doing it. So for us to go out and do about 800 units in a pretty short period of time while I was at my job, they gave me some confidence that we, can go out and actually do this before I took away my income stream and went out on my own.
Gotcha. And I know primarily people, or the one of your strategies, do you primarily go through brokers?
Yeah. So when we're like to source deals, I mean, usually there's a broker involved in most transactions, whether it be on market or off market, there's usually a broker involved. We have gone probably 4 or 5 times of the 40, 50 deals we've done. I've probably been direct without a broker, but usually they control the majority of the deals. And, Dallas, Fort Worth, where I'm based, or Austin, where we own, they're probably like most cities and most markets across the country. It's a pretty tight network of brokers. So in Dallas, Fort Worth, there's probably 8 or 9 small groups or shops or guys that kind of control 85-90% of the marketplace. And you go to Austin, there's about 2 or 3 that control about 90% of the marketplace. So kind of depending on where you are, it's probably pretty similar. So, you want to get access to these deals, they control it. So whether that is, like I said, a fully marketed deal, off market deal, doesn't necessarily matter in my opinion, as long as we feel like we're buying at a good basis or a good valuation. It doesn't matter if it's fully marketed or not, because sometimes these off market deals, you got to pay such a premium nowadays that maybe you're better off letting it go to market and no one else will pay that price, and you can then get it at a lower price once no one's biting on a high value. So I don't know if there's a right or wrong to it, but we definitely do both.
Yeah, and I'll later revisit that because I want to get insights on, some people say the chicken or the egg, how when you're going through a broker, they want to see that you've closed deals, but how do you close deals? That whole route.
Everyone starts at 0, right?
Yeah, fair enough. And so one segue question is it true that everything is larger in Texas? Because one time I was in Dallas and the hotel I was staying in, I went to the bathroom and the toilet was average size. So I don't know if it was just that hotel or is that true with everything's bigger?
Maybe not everything, but we do have a certain sort of pride to ourselves and everything we have down here. Yeah.
Okay, gotcha. And what on the syndication side or putting together the multifamily has been one failure that you encountered that later set you up for success?
We were fortunate that the time and up until just say the last several months, really the entire time I've been owning, the market's really been going one direction, which is up, which is very fortunate. As a banker kind of in the Great Recession, and ever since we've been owning, it's been a pretty good environment. So never really made any sort of major like deadly mistakes, but there's certainly we've had our fair share of mistakes. One thing that kind of jumps to mind, one of the stories that I like to say when I get asked a question like this is there was a third property we bought. We owned a property that was in a pretty difficult city. They didn't necessarily like workforce housing and at the city level, so they thought of themselves as a little higher statute than they probably were. So they're pretty tough on the code enforcement. So when we started out, I had a certain management company that was run by one of my buddies, pretty small firm, and they didn't do the best job of communicating with the city. And that really came back to start biting us in the butt a few years into it, where we spent a bunch of money renovating and fixing it up. And then all of a sudden the city still was like on our tail all the time. And then all of a sudden I started.
Did you have to just stop certain work due to them coming in and saying that's not?
No, but they'd come and do inspections and then give you correction notices. And then if you didn't correct this thing, and it was correct in 2 weeks, they issue a citation, and then you have to go to code enforcement court, and then they started getting just real punitive and like ticky tack kind of nothing low violations that were targeting us basically. So we decided to sell the deal. And as we're in escrow, we ended up getting like our annual city inspection that had 51 pages that had like 20 items a page of items to correct. And just, it was just like one of these things that just kind of like kept snowballing and snowballing. Eventually we ended up selling it, but it was a pretty nerve-wracking thing that really kind of reinforced pretty early on in my ownership career. You've got to make sure that you and your vendors communicate effectively with all stakeholders, including the city, and make sure you don't, kind of slough them off because they can come be vindictive after you yes. with code enforcement and some other things. And, it's just really important to make sure that you're choosing your vendors and your management company as your most key vendor, or if you do that yourself in-house, that you communicate with all the various stakeholders, your tenants, your investors, your banker, the city, whoever else it is. Everyone's kind of got a seat at the table and need to be, taken care of.
Got it. Communication is key, you guys. And now that I really want to jump into, especially your experience with the banking is, I'm a firm believer, and I would like your thoughts too, is yes, good to learn from your own mistakes, but even better to learn from others. What did you see on the lending side that people should not have been doing as an operator in terms of the loans that they've been getting or structures of the actual deals?
Yeah, when I was a banker, like I said, I was kind of the Grim Reaper 12, 13 years ago in the Great Recession, doing problem loan workout and trying to collect a lot of these loans that were kind of made pre-Great Recession, kind of the mid-2000s. And you really kind of learn. I certainly saw four things. I saw people that they did these four things, kind of got them in trouble, really, kind of. So these are some of the principles I took. So, one is, they bought in extremely high crime, lower socioeconomic areas, kind of bought.
The hood is what.
Yeah, the hood, right? A very tough location. So, necessarily say they're bad people or anything wrong with it, but it's just like you put your capital at risk, and these people just don't have the resources to kind of keep the rent current. If they had one little bump in the road, then you're going to have a hard time keeping your mortgage current or paying your tenants, or they just generally tend to be a little bit tougher on the assets from a physical standpoint.
And it looks good on paper, but in terms of actually translating to the real world or executing on that is the difficulty.
Yeah, there's definitely a difference between physical vacancy and economic vacancy. And if you own a property down there, it's one thing to keep the building full. It's another thing to actually collect the rent on a regular basis. And we're all going through that a little bit if you're in real estate today with, eviction moratoriums and all these things that you can't go and, really access the courts to go try to collect your rent from these people. And you're having to work through all that the last, 4 or 5 months of the COVID world that we're in now. So that was definitely one of them. Number two was these people didn't set aside and do a good physical inspection on the front end and set aside enough capital on the front end to cure any sort of known deferred maintenance or, implement their business plan, the value add strategy or whatever it is. So making sure that you come to these deals well capitalized. A lot of people came in undercapitalized. And a good example I'll use, like in Texas, it gets hot. Like right now, it's really hot outside. It's summertime. So ACs go out in the summertime. So if you don't have any capital side, you have an AC that goes out on an occupied unit, you got a problem. So you go to like a vacant unit, you take your AC condenser, put an occupied unit, and now you have a unit you can't lease, and it kind of snowballs and snowballs, so that's a good example of that.
And so, Michael, do you believe that an operator just doesn't have the proper way to structure to put in the reserves, or is it more of the deal is so tight they just don't have enough to actually allocate to the reserves, or maybe a little bit of both?
It could be both, right? You could either, some of the mistakes we made have been never critical, but it's always been like, I came a little light on working capital. Should I take that extra 100,000 or should I not? The more you take in capital, the worse your returns are going to look on paper because your denominator is bigger. So your cash on cash or IRR gets a little bit limit, a little bit lower. But like you said, it's you need to have a little bit of margin for error because unexpected things happen along the way, and you need
unexpected tends to usually be expected or happens.
Yeah, and then the older these deals or the tougher the deals, the more likely these non-recurring expenses kind of pop up and recur a little bit more often, like your sewer systems or your mechanical systems. So the buildings are just, 40, 50, 60 years older. If you're up in the Northeast, maybe even older, because a lot of these buildings are 100 plus years old. So they just tend to have more physical issues. The other two things really are improper management. So if you just don't have good, competent management in place, the story sticks out to me was a banker. We inherited a loan from a gentleman who was from California, sold a single family house and bought a 30 or 40 unit property in Dallas in the 2006, 2007 timeframe. And he was a UPS driver, and he tried to manage it from California here in Texas. And the end of the story wasn't very good because he just didn't have the skill set or knowledge to be able to manage it properly. And then finally, having a high level, putting the improper debt on it, which we talked more about, but maybe being over levered, high levered bridge loan, short maturity, and then you have that mature in 2008 or have that mature in February or March, have that mature in say March of 2020. It's a challenging time when the capital markets go off. They go off quick. That's kind of what I've seen. The markets kind of turn off and they're a little bit slower to turn back on. So if you're forced to sell it or refinance it at a bad time, so not that there's necessarily anything wrong with bridge loans, but making sure you don't fully max out the leverage, maybe build a little bit lower leverage. And
you meaning something such as 65, 70, 75, and what would you consider over or pushing up there, 80, 85, 90?
It depends on the deal, but yeah, 80, 85 is usually about as high as you can likely get. I mean, some people might put some mezzanine debt and take that to 85, 90% leverage. I mean, you better be in and out of that pretty quick, and you better have a clear path, because while that's great and can really amp up your returns, if things kind of go against you, you don't have a lot of margin for error. And then especially if you're a sponsor, you don't have deep pockets, and you can't solve your own problems, and you try to go to your investors for more money, and the kind of
snowball effect.
Throwing good money after bad, and a lot of those guys don't want to give you money if you already kind of lost that first chunk of it. So you can find yourself in some tough situations.
Gosh, so definitely I'm taking notes on this. The first point is buying in high volatility, the hood, let's just call it
high crime,
from that, and
high crime
then
areas,
high crime, high vacancy, and then so that allocation of reserves. That's the second one. Third one is improper management. Firm believer that bad management can turn a good deal into a bad deal, and then a bad deal, could you say a good management can turn that around as well?
Certainly can make it operate a lot more efficiently. It really kind of swings it's kind of the neck that kind of turns the head, right? It really can make you go in the right direction or the wrong direction.
And then the fourth is just good financing. So on that first deal, when you shifted from single family to multifamily, did you bring on investors? Did you do a syndication? What was the size? What was the overall structure?
Yeah, we're fortunate. My now business partner, when I was working at the bank, he was working for a broker out of California, and he had access to a bunch of high net worth individuals. For the first 4 deals, we really just had one guy was our partner in 3 of them, and we had a really small group of friends that was in the fourth one.
So a joint venture? Or was it still
it's kind of more like a joint venture. We did a private placement, but it was really just him and us. And then kind of going forward, we started kind of with the 5th deal is when we really started doing the $100,000 minimum syndication, kind of go out and pull a bunch of unrelated people together, which is kind of, we do a little bit of both now, both either just a joint venture with one-off high net worth people, or we'll do kind of your more traditional syndication. We tend to do a little more syndications than we do joint ventures anymore. There's some pros and cons to both. And we have not taken like private equity from like institutional groups yet, which a lot of people my size do. We've kind of stayed away from that and just kind of done the more traditional syndication route.
Do you plan on going that route at some point once you start to scale and grow?
I'm trying to stay away from it as much as possible. There's goods and bad. Nothing in life is free. So while it's easier in certain respects to deal with one person or one group, they control you a lot more than if you have 100 unrelated people. You kind of control your own deal a little bit more. So, while I have to do, like I did 1,100 K1s this last tax season, that's a lot of work, right? It's a lot of pushing paper. So that's kind of some of the price I pay. But if you go the other route, we've been so far able to do everything without paying a preferred return. So if you go the more institutional route, they're definitely going to have a preferred return and different controls in place that you don't necessarily have to have put upon you when you can do a syndication, because the syndication is kind of take it or leave it structured typically. So it's good and bad. There's no right or wrong. It's just kind of the route we've chosen to go.
And I want to dig into that. So you just do straight equity, no preferred return?
Yeah, so we'll just do like a typically an 80-20 split. So we'll generally get compensated in a couple of ways. We'll charge like an acquisition fee, an asset management fee, and then typically it's an 80-20 split without a pref. When you get these preferred returns, you can do like graduated waterfalls, and like it's maybe an 8 pref with a 70-30 up to 15 IRR and a 60-40 or to 18 and then a 50-50. And it's complicated. And so kind of knowing your audience, that's one thing. If you're doing some institutional firm, that's what they expect and they can understand it. But you're talking to some, like a salesperson or someone that's not in the industry, they're just kind of looking to put some money to work. A confused mind doesn't buy. So the more complicated you make your structure, the harder it is to explain to somebody, the less likely you are to get a yes. So we tend to just kind of keep it very, very fair, where you don't have it's a flat return. It's a flat split versus a graduated split with hurdles. And it's just a lot easier. And it's just, honestly, we just kind of did the first couple that way and it worked. And it's always worked. So we never try to mess too much with a good formula that's worked. I mean, I'm sure we could do something different, but we've done 40 something deals and it just always works.
Yeah. If it's not broken, don't fix it. And
right.
So same boat, did equity, did the preferred return, and then now just shifted back to the equity entirely, just straight equity, just to keep things simple. Because it starts to get, okay, when you hit this, we do a waterfall over that. And then when we hit another metric, it just gets so more complicated. And so from your side, how are you finding investors? Is it you've got your brand, Michael Becker, and then you're the one that's the face, and then it funnels down, or do you push through SPI?
Yeah, so a couple of ways. I mean, first it's a lot harder to get capital when you're starting out, but we've been fortunate to go full cycle on 20 some odd deals at this point. So, you get a lot of repeat investors, and then we get a lot of referrals from existing investors that, hey, my buddy has money, and you rich guys tend to flock together. You mentioned I have the co-host of the Old Capital Real Estate Investing Podcast with Paul Peoples, and so we get couple 3 calls a week off the podcast, which is amazing that people keep finding, more and more people keep finding us off the same thing, or I'll go on to podcasts like yours is the one we're on right now, so people find me that way. So some combination of that is kind of what we've just kind of organically grows. Occasionally I've had 2 different guys that we've actually joint ventured and kind of come together on the management team that have pretty big list. So if we had to do it, like we did a $27 million equity raise last year, and I joint ventured with another group that had a really large list, and about half the money came out of my database, about half the money came out of their database. Then we kind of break up the management roles and responsibilities for investor relations, and some of the major decisions we do together and try to make, in a compliant SEC fashion. So, that's one way a lot of people, when they start out, they'll tend to try to co-sponsor with another person. So they kind of pool their resources together, both from like earnest money purposes or their investor databases, and then maybe kind of delineate some of the roles and responsibilities of the money raise, plus, kind of post-closing, where this person might be more on operations and this other person might be doing more on investor relations. So that's a common thing I've seen, where you kind of co-sponsor when you're starting out into some of these deals. So we've done that concept in a little larger scale as well.
And when you were starting your firm, how did you determine, okay, for me, Michael Becker, these are my strengths, these are my areas I'm not so good in, and was able to figure out who to plug into that? How did you become self-aware enough to determine what your strengths are and then where to plug people into?
Yeah, I'm going to try to be pretty self-aware. I wish everything was as intentional as it turned out to be, something I just fall into. But, so my SPI is myself and my partner, Sean. And so we definitely have very different and complementary skill sets. So he's, a wizard when it comes to Excel, and he's this, analytical genius and got a good
spreadsheets, all that fun stuff.
Yeah, so he's really good at that. So, and so while I can do that, I'm just not going to be as competent as him. It's a little bit more of a struggle for me, where I'm kind of more on the investor relations and working with brokers, and that's a little bit more where my strengths are. So they're very different roles and responsibilities. So he's got kind of like certain roles and responsibilities where, out of his office, I run, anything analytical, so underwriting, all that, as well as the transaction coordination, placing the debt, working with the lenders, doing insurance, property tax protests, things like that. We're up in Dallas. We're kind of more on the asset management, investor relations, and unfortunately doing property tax or income tax returns and K1s and all that horrible stuff that I have to do every year. So it kind of naturally just split that way. And that's something, if you're looking to get in the business, find someone that has different but yet complementary skill sets to you. Because if that person is exactly like you, one of you isn't necessary in that relationship if you kind of do the same thing.
Because there's so many different aspects in the business that, hey, you've got everything over here. Now you've got to find someone else to, in essence, plug those holes.
Yeah. And if you don't want a partner, you can usually hire a lot of people to kind of take some of this off of you as well if you want to try to be a lone wolf. But, usually I've seen a lot of people be successful with partnerships, very strategic partnerships along the way. And those are, why it can be more expensive in the long run if you become really successful, because you're splitting up equity. In the short run, when you don't have money, you got to pay payroll. That's a hard hurdle to come when you're really kind of first starting out. So having, partnerships really helps compress timelines a lot.
And so for today, how are you competing on properties that are listed?
Yeah. So we're in 2 markets really, and we've done a lot of business in both markets. We've done Dallas, Fort Worth, and Austin. We've definitely done more in Dallas. We have an Austin where we're 2 or 3 years in Austin now. But, we're pretty well known in the marketplace, and, it's a completely unfair business, Sterling. A lot of it's who what chips you can trade. If I've done 40 deals and you've done 1, I got a very distinct advantage over you in my marketplace.
No matter how much I can pay or over,
right. Yeah. So, you're not saying you can't overcome that, and people do go from 0 to 1, but, with the bigger you are, the better it is in business. The more you've done, the more advantage you have. Because, if you think about it, the broker's job is, really kind of twofold. One is to get the best price or the best economics for their client. But really the other thing is to assess credibility of the buyer pool and, make sure that they can deliver, certainty of execution on top of that. So it doesn't matter if I pick a buyer that's going to pay more money. If they can never deliver on what they tell you, you're just wasting your time anyways. So, the more you do, the more credibility you have. And if I've done 3-4 transactions with this broker or 10 or 50, whatever it is, and you're the first time, I got a clear, distinct advantage. So how do you overcome that? I think that's probably one of the things that you want to talk about. How do you get that first deal done? Really a lot of it is just persistence. You're likely going to be disappointed a lot when you're starting out. You don't typically get the first deal you bid on. You don't typically get.
There's no way you don't get the first deal you bid on. No way.
Yeah, it's like it happens. It's like a unicorn though. It's not real. You got to go through a lot of disappointments, and you got to learn, and then you got to show up, and you got to give the broker some feedback. You got to start building a rapport with the broker or brokers, and then eventually, once you kind of fine tune that process, you've been at the table and kind of been the bridesmaid a few times, eventually you'll get picked. And you got to, just really structure your deal. So, what they want to find is, where's your equity coming from? Where's your debt coming from? How are you going to manage it? Do you have the ability to run an escrow and get this thing across the goal line? So if you've never done it, you need to start borrowing credibility and resources from others. So, I got the earnest money, or my partner and I can front the earnest money. Here's our investor pool. We feel confident with it. Maybe we'll even go hard with some earnest money to show our confidence and our ability to raise capital. I got a lawyer that's done a bunch of deals that people know in the marketplace, and a management company that the brokers all know in the marketplace is going to manage it and help me run my due diligence. And so you kind of assemble a team to borrow on their experience until you gain your own experience along the way.
Gosh, love that you mentioned about team and all those various elements. And one thing I really want to get your insights on as well is, how do you see us, COVID in the midst, sort of coming out of it? Who knows, the new normal, based upon your experience on the previous downturn that we've been in, where do you see things forecasting? I know you don't have a crystal ball or anything, but 8 to 12 months from now.
It's a really wide spectrum of outcomes right now. It could be great, it could be terrible, and I'm not quite sure exactly how to handicap it. I mean, if you look just from an operational standpoint, we basically have happened in mid-March. So March collections really weren't impacted. So April, May, June, now July. So we'll have 4 months as we record this of actual data. In a normal month where you would kind of pre-COVID, we collect over 99% of our scheduled rents. So have a little less than 1% delinquent. For the last 4 months, we've been basically averaging about 97 or a little bit better collection. So about 3% delinquency. So while that is, elevated, 200% or whatever, it is still pretty small, all things considered, especially considering we don't have access to the courts and can't file evictions and until recently haven't been able to charge late fees and things like that. So the normal collection tools are your hands are largely tied. So, if I just would have hibernated in February, woke up today and just only looked at my financial statements, you really wouldn't have seen a whole lot of economic impact. So, right now, as we recorded, it sounds like the government's going to probably pass some sort of extension to the additional stimulus act to kind of help it. Because I think the enhanced unemployment and the one-time checks really have kind of supported the capacity of a lot of our residents to pay. So if that goes away, I mean, I think that's, can have some impacts on us, until we get a vaccine and start opening the economy up even more than it already kind of has. So I'm a little uncertain on kind of how that goes, but right now, the Fannie and Freddie debt is still pretty available. They put some pretty strict escrows, some additional escrows right out of the gate. Those are starting to loosen up and scale back a little bit. And, interest rates really were kind of, call it plus minus 4%, generally speaking, back at the beginning of 2020. Today, they're kind of plus minus 3%. Pricing, the deals that have traded or on the market, generally getting basically the same price that they were going to get if they would have launched in January here in kind of the summertime. So really pricing hasn't moved, at least in the Texas markets I pay attention to. I'm sure in New York
and one thing on the pricing, when you're underwriting a deal, let's say you're going in at it at a 6 cap and it's more so stabilized and maybe a small upside in terms of a value add. Are you steadily saying that in 5 years cap rates are going to compress a little bit, or you're going to say it's going to be at a 5.5?
Yeah, right. So how do you underwrite these things, right? So there's a lot of unknowns, and so I think we're being very conservative on the rental rate growth, which we always try to do that anyways, but try to be conservative on the rental rate growth, and then your cap rate. I mean, I don't think you can adjust. You can. In normal times, underwrite a lower cap rate than you should have some sort of expansion in the cap rate. Because 5 years out, I don't know, who knows what the world's going to look like 5 years out, right?
We may not even have multifamily. No, it could be.
But what's happening though is like I said, pricing's the same, but as I mentioned, interest rates went from say 4 to 3, so you're getting 25% to maybe a third off of your interest rate. So if you can have 3% interest only mortgages, these deals are actually underwriting and sizing really well. So, if you buy at a 5 cap borrow, 75-80% at 3%, you're going to print money. You're going to make high single digits walking into this deal. So, I mean, it's going to be supportive of cap rates staying kind of where they're at or going down. So that's kind of my crystal ball. I bet you cap rates stay where they're at or go down. The big wild card is, do collections just fall off the cliff if there's no more stimulus? And does it get us to the point where we have a vaccine and these jobs really kind of come back to full employment? You also have, political risk, right? So we have an election. Who knows which way that's going to go? No matter which way it goes, I think that both sides are going to print a lot of money. So I think at some point, we're going to see a lot of inflation. Maybe really might be a few more years where we see consumer price inflation, but we've definitely already seen asset price inflation with, say, the stock market is, at basically all-time highs as we record this. And, we're in a major recession with 20% unemployment or something like that. So it's a weird world with a large spectrum of outcomes. But, I think in 10 years from now, I think we see materially higher real estate prices, especially in multifamily, especially if you're in good areas, landlord and business-friendly environments, population growth, job in-migration. Those are, Texas, Florida, Arizona, places like that, I think will do well. If you're in New York or you're in California or you're in some places like that, Chicago.
Maybe Chicago. Yeah, that's what I was going to mention, Chicago.
Yeah, I think you can't keep taxing people because they're going to move, and it's going to further compound their problems. And these corporations are leaving high regulated, high tax locations. So if you just buy in Texas, Florida, Arizona, you kind of get the wind at your back. And I think in 10 years from now, it's going to be worth a lot more than it is today.
Awesome. Well, definitely, you guys, you want to go back and review that part. So many different outcomes that are uncovered in that, but just understanding the frame of mind is one good in terms of insights. So now we're going to shift to the rapid fire sharing round with just some quick questions for you. First one is, what is one common myth that you hear in the syndication space that you can debunk?
One common myth. I think a lot of people have said that, C class is less risky than A class. You kind of hear that on the podcast circuit. I think that's not true. And in my experience, from a couple standpoints, one, The durability income tends to be a little bit greater if it's a little bit nicer deal. I mean, obviously A class, you can have another new deal built next to you that maybe competes with you a little bit more on concessions. But like in C class, your tenants don't have the same durability of income. And we're certainly finding that out. And in the recent months, with a lot of these people that live in workforce housing tend to have, jobs where they physically have to be somewhere. And then if you can't physically go somewhere because there's a global pandemic, then their income gets disrupted. You also have a lot of the physical risk and the older assets that you don't necessarily have in the newer stuff. So you have the ability to miss on your kind of your capital expenditures or your recurring R&M on these deals, where if you have these old sewer systems or a boiler system that goes out that's $10 to $20, $30,000 you didn't budget for, that could really impact your actual cash flow. So those are two things I think that people should think about. The other one that really has been a big paradigm shift for me was when we first started out, we did a lot of fixed rate debt. That tends to have either yield maintenance or defeasance prepayment penalties, these really large prepayment penalties. And it turns out that was a riskier move than actually taking floating rate debt, because the floating
so
rate
you said it's better to take the floating versus the fixed rate,
at least
is what you meant?
with the benefit of hindsight, certainly in the last, say, 10 years, every time it would have been better floating than fixing, because we bought these deals and we thought that we get a 5% rate, and that's as low as it's going to be. And you get your 10-year term with 1 year interest only, then it amortizes, and all of a sudden go forward a few years, and then all of a sudden 1 year of IO turned into 3 years of IO, and then turned into 5 years of interest only, and the rates went from 5% to 4%. Now they're at 3%, and then what happens is your yield maintenance, you want to go sell that deal, and you have 5 years left on your loan. Yield maintenance is a calculation based off of like the how much time is left to maturity and then what your note rate is compared to current rate. So if your rate's at 5 and the current rate's at 3, your prepayment penalty goes up dramatically, so that bondholder then replace a lower interest rate bond and get the same yield, right? That doesn't get too complicated, but these prepays have just blown up where, we had one where we, try to sell a deal, and we're going to have to go from an all cash, because our prepay went from about $7 million to about $9 million in a matter of a month, because the rates kept falling, in COVID. And so we're taking, it's just a paradigm shift where if I had a floating rate loan, I could have sold it. So if you don't want to own that thing for 10 years, that 10-year money can really have some alternative impacts to you. So just kind of thinking through and avoiding yield maintenance and defeasance prepays are something that are of utmost importance to me today, that I didn't necessarily understand when the front end of the career, the exact ramifications of that. And we have that lesson tens of millions of dollars over. I can tell you about that.
Got it. And so what has been one gift someone's given to you that's been most impactful that's been under $100?
I think I'll say it this way. One of the gifts I give people that are trying to start in this thing is a book, right? So I'm not the biggest reader, but there's really kind of two books. So one, I'm kind of become buddies with Ken McElroy. So I think his two books, the ABCs of Real Estate Investing and the Advanced Real Estate Investing Guide, he has a pretty good business model that's pretty similar to what mine is in a lot of ways. That's kind of a good fundamental. And really, Tax-Free Wealth by Tom Wheelwright. I think if you're really trying to understand the tax code, that's a really simplistic way of understanding some complicated subject matters, and at least give you some talking points to talk to your tax professional with. So actually, I ordered that book for one of my buddies from high school who's going to try to start getting in the business. So I bought that for him this morning on Amazon and sending it to him, because he's had all these questions. I'm like, just read this book. It's a lot easier than me trying to tell you about it.
And so one last question is, why do you believe we're here on this earth?
I don't know. That's a good question. I haven't thought about it. I like to do things that kind of bring me joy and a lot of I like
swing dancing.
Yeah, that's right. So I don't have too many hobbies anymore, so I don't do that anymore. But I like what I do. I like working. I like doing deals. I like being in transactions. I like trying to help people out. It's what I like about this business. I don't know if this is a direct answer to your question, but it's a feel-good business. If you do it right, you can do well by doing good. You can take a broken property, you can fix it up, you can improve the quality of life and the safety of the residents on the property, and then you get your investors, return, an outsized return at lower risk on the money they invest in the deal. And if you do all that right yourself, you could profit off of it and go out and be able to travel and spend time with my family and all the other benefits that come from being in real estate investing. So I don't know, that's why I'm on this earth, but That is what I do like about the business.
Okay, so to enjoy it, the life, and also to be of service to others, in essence.
That's right.
Okay, perfect. Well, where can people find you, Michael?
Yeah, like I said, there's two ways. You can just go to look up the podcast, which is Old Capital Real Estate Investing Podcast. That's on iTunes, Stitcher, or probably anywhere you hear my voice right now. Just search Old Capital, you'll find it. Or my company, which I run, is SPI Advisory. So just go to our company's website, which is www.spiadvisory.com. It's SPI like spy, advisory.com. There's a contact us form, fill that out. We're always happy to send out information about people that want to learn a little more about what we do.
Awesome. Well, thanks so much for being on the podcast, Michael.
I appreciate it. Thank you.
Yes. And those of you on the YouTube, of course, you want to hit that subscribe button. And those of you who are on the iTunes or any place where you're listening to it, leave that 5-star rating. It would mean the world. Keep being awesome, everyone. Thanks for listening to The Real Estate Experience. If this has brought you any value, please subscribe and leave a 5-star rating. It would mean the world to me. Now go out there and crush it.